Hello, my name is Eddie Tofbig. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. 13 weeks ago I said here, and I quote, "The only other thing to bear in mind is not here on this daily chart, but in Chicago soybean meal." And that is the well-highlighted annual key reversal down we saw there for 2023. Not directly related here, but not worth ignoring either. End of quote. All things this year and going forward, all things into the future should be seen in the shadow of this pattern. Okay, so part of the recent action has seen the market create what looked like a possible double bottom over February and May, which may now be moving towards a possible triple bottom, if you look at and include June's actions. However, another pattern that has taken some of the recent supremacy in the market actions, though this is now very much being challenged, was a late February to late April mildly bullish shift pitchfork, highlighted in dark blue on my daily chart. However, last week prices exited down through the lower time, currently at 1169. And this brings me to another point I made 4 weeks ago, and I quote, "And that is how the action throughout May is now on the verge of becoming a double top Adam and Eve type. It is not a done deal, but we are close, and I would look to this idea should we see strong consecutive closes below, in the immediate future, below both the short medium moving average, that's currently 1190, and the medium moving average, that's currently 1187. We're not there yet, but a primary move lower would be about 28 cents, and a secondary hard to reach move would be about 52 cents once we have confirmed a move below $12. One additional point, and that is sometimes double tops such as this one appear after a very large decline and can indicate the end of that decline soon. So just be aware. It doesn't happen always, but it does happen enough times to be noticeable." End of quote. Well, these potential moves lower came true for primary target 1175 and the secondary hard to reach target down in 1151 zone. The primary target was achieved 3 weeks ago and the secondary target was achieved 2 weeks ago. The next feature is one I drew and spoke about 3 weeks ago, and I quote, "I have drawn a new, small, recent, bright red highlighted bearish Andrews pitchfork for the action during May. It is a nascent pitchfork, but I've decided to place it in the anticipation of a possible move lower." End of quote. Well, I've not had to do anything to this pattern, this pitchfork, nothing at all, as it's still working and working well as a bearish Andrews pitchfork and showing the bearish angle of attack. Looking below now, well, we still have the December 2020 low at 1143, which has been tested nearly every day for the last week and a half, including today, as well as the late February lows at 1133 and 1128. And these two could be significant, these last two, as they held up prices back in February. But we should bear in mind that below these three, we really only have the 61.8% absolute Fibonacci line in the way at 1106, before we test down to the November 2020 low at 1045. That is something to ponder upon. Chicago soybean meal. The market consolidated in late February this year down at 326.90, but this congestion was different compared to earlier ones, as we had crossing through it back then the dark blue highlighted extension to the lower trend line, currently at 325 even, of the July to September 2021 descending triangle. I said 15 weeks ago, and I quote, "This may be nothing, but I'm minded after such a fall as we've seen since last November, last year, that this may see some hesitation around the 327 to 325 zone. I'm not certain on that, but it is worth considering." End of quote. Well, prices utilized this blue highlighted extension to the descending triangle as a base and rallied back up, creating a very early February, early May sideways triangle. We advanced quite a way along this coil of this triangle until breaking up on the upside in late April. Prices swiftly reached the primary target and soon after the hard to reach secondary target. However, once all the work was done on the way up from the sideways triangle, the market started to waver, notably being capped in early May by a combination of the declining long moving average, currently 372.60, and especially by the 50% Fibonacci line of the August 2020 to March 22 move at 390 even. Prices backed off down to the nearest congestion area between 363.70 to 368.80 zone, and we stayed between this congestion below and the long moving average overhead, forming a small double top over May, until 4 weeks ago when prices finally fell away with an immediate countering weekly key reversal down. This left the primary target below for the double top at 352.40 and a secondary hard to reach target X down at 343.30. Now the primary target was reached 3 weeks ago, but the secondary target X is still alive. There are some other features I'd now like to discuss. First is the green highlighted short medium moving average, currently 357.40. This had been a support, but over the last 2 weeks has become overhead resistance. Then there is a key level just above the mauve highlighted medium moving average, currently 348.40. It is the congestion at 349.20. Now this had provided support for the first 2 weeks of June, but since then has been breached on a couple of occasions, most recently yesterday. The second feature is the bright red highlighted May-based bearish Andrews pitchfork, which I drew 3 weeks ago. You may remember I only drew this pitchfork to help in showing the channeling lower of the market, and I was happy to finesse it or retire it as necessary. However, the market has taken on board this bearish pitchfork, and prices are right now in between the middle time below, currently at 340.5, and the upper time above, currently at 354.10. I'd keep watching this bearish pitchfork as it continues to show the bearish angle of attack of the immediate market. Finally, I will raise once again a key point I raised here 52 weeks ago, yes, a full calendar year ago, and on every opportunity since, especially at the close of 2023, was how the whole of 2023 was an annual key reversal down in Chicago soybean meal last year. This feature, this potential if you like, hangs over all of this market more than anything right now, and all action should be seen in the shadow of this pattern. Chicago soybean oil. The market's drift of sideways to lower this year has been down through 3, possibly 4 bands. These were, or are, 44.68 to 45.04, made up of the 2014 high at 45.04 and the May 23 low at 44.68. Then the tight 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line at 43.80 and the April 2014 high at 43.94, with the nearby neckline, highlighted in bright red, of the October 2019 to February 2020 head and shoulders top. That's currently at 44.02. Then there's the interesting congestion down at about 42.65. Now I mentioned all of these because some 50 weeks ago and numerous times since, I said the following about a big descending wedge pattern that was on my daily chart back then and is now high up off the top of my chart. I said the following, and I quote, "I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern." End of quote. This was a big pattern idea, and the market's decline since autumn of last year fitted in with this, with the expectations I voiced of eventually witnessing a fall down to the area of the May and June lows between 48 to 46 even, which is where we have been until recently. I've often stated here that I am keeping a very, very close eye on this idea, as any significant breakdown below 48, 46 even zone could signal the start of the rest of this move lower. I said 15 weeks ago, and I quote, "So far I'm not convinced of the move, that we've seen this break lower already. No, not just yet. However, 3 things to bear in mind. Firstly, this is a really big pattern, stretching from November 22 to date, so do not expect the immediate sharp movements. Secondly, data indicates about 3 out of 4 times the market breaks lower. Just be aware of that. Thirdly and finally, I would like to float the idea of the recent unusual bear channel." End of quote. Now the bear channel I mentioned is highlighted in dark blue on my daily chart, and it's currently 38.36 to 45.31 and started at the beginning of 2024. Mixing with this bear channel and close to the upper bear channel line is the green highlighted short medium moving average, currently at 44.64. Now I previously used this moving average as a proxy for the upper bear channel line when I began tackling or tracking this market, this pattern here, before I drew a proper upper bear channel line. Now we saw back in March, April, and actually a little in late May, attempts to edge out to the top side of this bear channel. But so far these have been unsuccessful. Right now, for the last 2 weeks or so, I've been playing around a little underneath the following: the dark blue upper bear channel line, the green short medium moving average, and also the mauve highlighted and slowly declining medium moving average, currently at 45.88. At the same time, we are sitting right now on top of congestion, situated between 43.80 to 43.94, as well as around the bright red highlighted neckline, currently at 44.02 of the October 2019 to February 2020 head and shoulders top. Moving now to another pattern, and 4 weeks ago I drew a green highlighted late November 2023 to mid-March bearish shift pitchfork on my daily chart. I commentated on this at the time, and I quote, "I'm looking to this to possibly act as a form of bearish channel," end of quote. Well, so far prices have just about justified this idea, crawling along the middle time, currently at 43.81 at a fairly shallow angle. All this added up to my saying 3 weeks ago, and I quote, "What I do realize now is this chart is becoming increasingly messy and too colorful in too small an area, especially as prices started testing the bright red neckline once more and come close to the congestion at 42.65 that held up the market in early May." End of quote. Nothing since has changed my mind other than the topside pressure has moved a little closer down to the market.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.